business is the consideration of the security transactions.
Thank you. So I have here the report from November 20th, 2023 through December 8th, 2023. We had total purchases of $215 million, total redemptions of $242,200,000. And that concludes the report on the security transactions.
To entertain a motion for approval of the security transactions.
So moved.
Second.
It's been moved and seconded. All in favor?
Aye.
That motion passed. The next order of business is the market-to-market evaluation.
Thank you. So this report is as of November 30th, 2023. And we have the fair market value of $9,753,915 compared to the previous report of $8,866,942. And we're looking at the 10-year Treasury. It was a drop from the last presentation in October, 4.88 to 4.37%, and the SIFMA also dropped from 4.09% to 3.30%. And there has been no collateral postings on these exchanges.
And that report is for informational
Information only.
purposes. Are there any questions? Hearing none, we'll now move to the next item, which is the debt study recommendations.
Thank you. So we're asking the board to consider and endorse the revised debt policy, which increases the GO bond budget amount from $80 million to $125 million, and also to approve the updates to the matrix, which will be used to analyze the city's ability to afford the debt. So for background purposes, in 1989, Mayor Kirk Smoke had appointed a debt committee to review the policies that was established in 1961. And at that time, the debt GO bond limit was $15 million. At the conclusion of their review, the board recommended that the city increase its tax-supported debt limit to $60 million over the next 6 years, and that the policy be reviewed every 5 years. So at that point, the city had raised its debt limit to $60 million, and it remained unchanged for 16 years, except for in 2010, it was increased to 65. And then in 2013, the board approved the current approval of $80 million. So in adherence to the policy, the Director of Finance had engaged the Public Resource Advisory Group, PRAG, to provide a recommended change or amendments to the city's existing debt policy, which includes adjustment to the annual borrowing limit and to look at the key debt management ratios. So today I have Jessica Donnelly and Christopher Lude to go over the results of their debt study and the recommendations that the city is standing behind to support the increase up to $125 million.
Thanks, Janelle. Thank you all for having us here today. We are really happy to be here and report the findings of our debt study. I know we had some briefing discussions with some of you last week, so we're not going to spend a lot of time going through all the materials, but as Janelle mentioned, the city's debt policy has been in existence for a very long time. We think of it as a very strong practice for municipal issuers to have those types of policies, and included in the policy is the mandate to make sure that it's reviewed every 5 years and reassessed to make sure the policy itself is adequate to not only address the city's needs, but also be in line with best practices across the municipal space and municipal industry. Our mandate and scope in developing the study was to reassess the levels or the metrics that are used to manage the city's debt profile, and to determine whether or not more debt could be assumed by the city over time. And in doing that, we tested not only ratios, but also budget capacity and how much debt service any increases would be. We also looked at what was appropriate targets for fund balances to make sure you maintain liquidity, as well as pay-go, so what the city might fund from cash. What of the city's capital program should be funded from cash versus debt. In doing our assessment, we looked at the city's financial profile. We also looked at rating agency criteria. We looked at peer issuers, so other state of Maryland, other counties, cities, local governments in the state of Maryland.
Oh, must have popped out.
You shouldn't have to touch the cloud at all. If you could put it into the wrong mode,
Oh, because it was on. Right.
it should be hearing mode. If you go into the other mode, you have to accept every time someone opens up a mic to allow them to speak. So it should be in that mode, so anyone can talk and then press their button.
So did you hear him?
Yeah, if you talk now, we should be able to hear you.
Can you hear me now?
Yeah, why don't you tilt it up a little bit?
All right, is this better?
Oh, yeah.
Okay. Do you want me to go back through really quickly what I just reviewed? I can,
So Russell, are you saying that this wasn't going out?
Yeah, but what happened was, Randy could hear you should not need to press this at all. Because it goes into a mode where Evelyn, if you talk, Evelyn has to accept you and turn your mic on.
Okay.
Now it's red.
If the viewers could not hear you, then we should probably.
Yeah.
repeat, okay,
Yeah, I'm going to talk to Randy outside to make sure he can hear you.
okay.
And I'll put a thumbs up throughout the door.
So I'll pause for a second.
So just start talking and I'll...
I was just about to transition, but we'll go back. I'll try to go through it again. But as Janelle mentioned, we are working through what is the city's 5-year requirement to review its debt policy, which is obviously a strong practice that we do, and we prepare these studies and review these studies regularly for other issuers across the country. So this is a culmination of work that we've done over several months, and are happy to report that we considered a whole host of factors, primarily peer analysis, rating agency analysis, along with industry trends as we reviewed the city's debt policy and established the metrics that the city could use for its policy going forward. And our recommendations are including adjustments to the level of the debt management ratios. So this is the actual statistic. We are one unique attribute to this year's study, which is different from prior year's studies, is that the rating agencies are moving away from the category of debt or the compilation of debt known as net tax-supported debt, and they're looking more at governmental type debt and business type debt, which is how the city reports it in their financial statement. So we did work in our study to conform to that presentation so that, again, it would make it easier for the city to track the ratios on your own. We are incorporating all of the city's comprehensive liabilities, so this includes your pension and your other post-employment benefit liabilities. And we are recommending, or our analysis indicates that the city can increase the amount of debt that they borrow annually and stay within the prescribed, what we believe, more conservative debt management ratios. We think that's appropriate, but when increasing that borrowing profile, we think it's important the city reassess the ratios more frequently than every 5 years. And we think annually is a good goal and best practice to assess them annually, and that can be done internally without necessarily bringing in a third party. And then we also are recommending that the city continue its best practices of using pay-go or cash to fund capital projects and planning for that, including it in the budget. We are recommending the city continue to maintain its policy of having a fund balance of 8% of the subsequent year's operating budget. And the other one would be the maintenance of the policy itself and using those ratios to govern and guide how you borrow into the future.
Just when you say that you do agree that it's a good idea to, and this is where I was unclear, what was the term you used for doing this every year? Is it review? Is it adjust?
It would be review and assess where those ratios are, and to the extent that they have more pressure, then you might make an adjustment to what your borrowing would be.
But that's just an internal review by city staff. It would not require.
That would be our recommendation, and we think it should be a formalized internal process so that there is perhaps a committee or a group, or Janelle and her team will prepare the analysis, and therefore you have multiple people making a determination whether or not you should proceed with borrowing at a higher level, or if revenues have come in below what our expectations were, or what your assumption was, that you would reduce that amount just to make sure your debt management ratio is staying within our targets.
Okay, well, without getting ahead of myself then, I'm just checking to see, so this would all be what we're doing within whatever ceiling or cap we set for ourselves.
Exactly.
Okay, all right. Thank you.
Exactly. So I am going to ask my colleague Christian Lund, who's here with me, just to review the metrics that we're recommending, and then he'll talk briefly about the scenario analysis that we completed.
Thanks.
Hello, Christian Lund, also with Public Resources. So we have provided the reports. I know this is just a bit of a review for y'all, so I'll go through it relatively quickly, but some of the metrics that we're recommending using, I don't know if we could go to slide 2 just very briefly. The recommended metrics, yeah, thank you. So we do have them here. There are a number of what we're calling governmental type metrics. These are metrics related to governmental activities. You can see they're just a series of ratios that we view as like a best practice after reviewing on the rating agency methodologies and the peer performance and the city's performance, as Jessica talked about. Additionally, below that, we have these all type metrics. This just incorporates also your business type activities. And we think that by sort of looking at these and keeping them within that range, that we can make sure that the city's debt stays affordable. So we wanted to test these. And if we could just go very quickly to, I guess, why don't we go to slide 5, if that's okay.
I do think the version that's up might be the prior, not the final version, so it could be a little bit different.
Fair.
In front of you, just
Fair, okay. So we did work with the city to sort of put a model together using your expected financial performance to project out what these metrics would be under a variety of different scenarios over the next 5 years. Our model actually went out farther than 5 years, but obviously the focus of this was the 5 years, so that's what we show. Once we ran these, we also did some sensitivity analysis. We looked at revenues. Yes. So we did look at pessimistic scenario that we worked with the city on. I'm happy to say it didn't materially impact any of the conclusions that we came to. And we also looked at these different scenarios and tested things under a variety of different ways. So what we found was that of these scenarios, we had some where you stay at your current level of issuance. We had some where you do a big catch-up issuance and then perhaps even issue more in the future. The staying at your current level obviously stays within your affordability metrics, but our understanding is there are capital needs that need to be addressed, and so it wouldn't provide sufficient capital. Some of those more aggressive ones, a large catch-up issuance or a more aggressive phase-up in the future, we found that those actually would pressure the city's finances significantly. We landed on this sort of Goldilocks range for what we call just Scenario 2 and Scenario 3, where we phase into $200 million over the next decade or so. I think by fiscal year 2032, we would see $200 million a year. So what we found, and I guess we can just maybe look at Scenario 3, which is slide 8, I believe. There's both Scenario 2, which would have Scenario 2 had $110 million GO bond issuance in both fiscal year 26 and 27. And Scenario 3, which had $125 million in 26 and 27, met our affordability metrics and seemed to be, based on our current projections, affordable levels of debt for the city. I just want to note a couple of things. Anytime you increase your issuance, it will sort of by its nature start to decrease your GO bond payout ratio a little bit. So that does fall slightly below our floor in both of those scenarios, but our floor is 60 and you go down to 59%. We don't think this is something that that is a major concern because it will start to recover as you move farther past those issuances. And other than that, you stay within the target in both of those scenarios. And as long as we are continuing that annual review, testing these things and reviewing the city's performance on a regular basis to make sure that the assumptions are still holding up, we think that both scenarios 2 and 3 are affordable. Thank you.
Great.
Sure. Do you want Happy to.
Are there any questions? Yes.
I only have one, so let me. I'm going to sneak in front of you in the grocery store and just go first with my one question is there something particularly magical about the 60% number as opposed to 55? And the reason I say that is if you're not concerned about dipping a percent below it, then my question is that because the 60% threshold was already itself very conservative and something lower could just be our goal?
Yeah, I think 60% is a best practice.
Okay.
I think we see 50%, we see 65%. But I think in this case, and Jessica, if you want to add anything.
The 60% is also what was in the city's debt policy to begin with. And so as we assess different ratios, we were looking for where we thought changes were appropriate. So 60% is still, as Christian mentioned, it's a best practice. It's reasonable. That when we hit the 59 is also driven by the date in which we plan the issuance. So depending on the part of the year in which the city issues, we may not ever trip that ratio up.
Okay.
So if you think about it, it's how quickly you pay down your debt over a 10-year period. So if you issue after you just made a principal payment, so there's if you issue less, if you have more premium bonds versus a par bond assumption. So we feel comfortable that that's within your. Yeah.
Gotcha.
And I just want to add a quick point of information to the comptroller's question, which is if you look at Scenario 1, you'll actually find that we are still going down on the 10-year payout ratio, which seems a little counterintuitive at first, because in scenario one, we're not changing anything. Scenario one is just do everything the same. The reason that happens is because this analysis is built to be safe. And so it's built to assume that every dollar of authority actually goes out onto the ground. And that itself is a substantial level of safety, because the reality is construction projects slide, sometimes you hit bedrock, et cetera, et cetera. Based on just my own experience, I would say it is very rare that you are so tight up against the exact 100% of what you issued.
Fred?
No, other one. Yeah.
Here we go. You built a model. Did you back test it?
Did we
Back to-
we do like a quality control review, so.
Yeah, that's what I'm asking you.
Yeah, absolutely.
So the model was back tested?
Yes.
Okay, that's the easy question.
No, you had a list.
Oh, I do. Every
I'm
place.
just checking them off as we go.
Okay. What are our, you had charts, I think on page 24, peer cities. What are our peer cities doing with respect to their debt policies? And I'm not talking about Washington, D.C., because that's the federal government. I'm talking about Pittsburgh, Cleveland, Buffalo, all the cities with really good football teams
Well, in other years.
in other years.
So I'll touch on just at a high level, nationally. We find that almost all of our clients, including other cities, are always focused on debt policies. We as a firm in general, if we have a client that doesn't have a debt policy, or if we come new to the client, we always are recommending that they revisit it, make sure it's still appropriate. So I know that Christian has spent a lot of time in the last, 90 days and probably for the next 60 to 90 working on debt policies for other Maryland issuers. But debt policies in general have become, a heightened focus for the rating analysts as well. They want to see good ingrained practices among issuers to know that, there's a prescribed policy that'll sort of succeed every person that is in a debt department. So they want to, see that. So I would say, I can't speak to exactly what every city that you listed on the pier is in terms of where they are at this current point in time, but I can tell you that they have policies, they are revisited periodically. Oftentimes they include a rule or requirement within the policy that it be revisited every 2 years, every 5 years, something
Okay,
like that.
all right.
So, and if you want to add, I know.
Yeah, well,
The only thing I would add is that I think compared to a lot of jurisdictions outside of the state of Maryland, or rather, jurisdictions outside the state of Maryland don't have nearly as robust of practice as a lot of issuers, most issuers in
Yeah.
Maryland do.
Well-
I would say the city of Baltimore is ahead of some of the other Maryland issuers. The 5-year sort of mandatory review, I think, is a really good practice, that sort of thing, so.
I guess the only thing that really troubled me somewhat in this as we ramp up our geo issuance is begins at the bottom of 17 and express concern over the city's long-term demographic needs of population decline as well as revenue-raising flexibility. And that's where I've been involved in the business community here for over 55 years. And a long time ago, this city had some real economic gravitas. There were a lot of major companies here which have disappeared. USF&G took 3,000 high-paying jobs with them. And the argument is often offered, well, look, UMS and Hopkins have taken their place. They have well-paying jobs, but that is not the same as wealth generation and tax flexibility. When you lose the USF&Gs, when you lose the Black & Deckers, when you lose 5 independent banks, it really seriously limits your ability, your flexibility. And that's a caution that I would advance, and I'm sure you're very aware of it. I hope you will. Yeah, go ahead.
Why don't you guys address it as far as it pertains to your analysis, and then I'll address it on the city's
Right.
behalf.
So what you're referring to in the report on page 17 is S&P's assessment of the city. So they're an
Yeah.
independent third-party ratings assessor. So when we did our analysis, we were focused on that same page. When you look above,
Yeah.
there's 7 different categories so part of when we established our metrics and we did our calculations, we built in inherent conservatism, knowing that those different types of components are a part of the rating analyst assessment and that the city can't control it. So we think of debt as being the area the city has control and those being.
Well, that's what
Yeah.
that's exactly
Yeah.
that's exactly what I'm saying. The city, notwithstanding best efforts, doesn't control that. That's
Yeah.
it.
So we did intentionally try to be overly conservative in our analysis.
That's not bad.
To allow for, fluctuations in other components of the ratings assessment. And we understand where you're coming from, but it's part of, we think of it holistically, knowing that these other categories can't necessarily be, shifted very quickly. Debt is something that you can make a choice and decide whether or not to downsize an issue if there's a pressure somewhere else, which is, again, part of what comes along with that more frequent, review of those debt ratios.
Okay?
Well, thank you. And I'll start by just sharing good news before we talk about bad news and worst-case scenarios. The good news is that in these last few years, our revenues have been holding strong and recovering well. We are actually seeing growth in young people coming into the city, even as we have demographic changes and some older people move out. Younger people are moving in, and they're moving into higher paying sectors, and we're seeing very sustained growth in our income tax. And I'll talk just in a moment about what happens if that isn't the case forever, but today it absolutely is the case. We've got great growth in income tax. We've got very solid growth in property tax. We do have weaknesses in areas that were hit hard by the pandemic. The downtown is perhaps the most visible of those.
It's highly visible.
There's a lot of work going on by some incredible people to figure out how to solve that problem, including, of course, the Harbor Place development and other projects as well. But I just want to kind of note that good news at the top, because it really is, I think, sometimes surprising to people to realize actually we are doing quite well on revenues and on the quality of life metrics that matter to people. Crime, particularly the murder rate, is down this year in the biggest single year decline in Baltimore City's history. So all of these things are important. But to the question of what happens if that were to reverse, if we cannot, for whatever reason, sustain the positives that we've been seeing. Part of it is, well, I would say the safety that's built into this analysis. It kind of assumes a little bit of the worst case, but part of it is just in how the city does its budget. So we have a balanced budget requirement. We do not borrow ever to pay for our recurring operating costs. And when we have tough
There you go.
years,
Yeah.
whether
Okay.
it's because the revenue collapsed or because an unexpected expense hit us, and both have happened quite a bit over Baltimore City's history, we always tighten our belt and adjust our expenditures to our revenues. That's a big part of why we have the really high bond rating that we do, is
Okay.
we always sort of plan to the revenue reality.
Okay, yeah.
All
right,
Fred, just a follow-up to that statement, is what was your base year from an audit report standpoint, the comprehensive, was it 20?
It was 22, because that's when the audit was complete, but we did work with Janelle, and we used the city's databases to make sure from like a debt perspective.
Okay.
We have our own calculation out of future debt load, and then we layer it on, and then we worked with the the full work, our team to develop assumptions for future performance of revenues and the different categories that fall within our tests. So fiscal '22 is the last audit, but then we,
I would've done
collectively
5
worked as a
years, but
team to
that's-
come up with
'cause
what
they-
the
'cause they're
expectations
taking
are for
this
fiscal
well
'23
beyond
and then
6
beyond.
years. But
Thank
let me,
Fred?
can I suggest a metric in your analysis? The number of MARC boardings. That is, if you look at the population of Baltimore and how it's changing, there are an enormous number of people who are now living here who commute to Washington. It's a younger
Oh,
pop.
marked boardings.
I'm sorry, that's,
I thought you were saying marked, okay.
No,
All right,
no, no.
okay.
if you take the trains, and I take the trains a lot, I think it's a very good metric on where the future, where current growth is being generated. An awful lot of people, young people who you referred to, who are taking the MARC train to Washington. They have good jobs, and Baltimore remains affordable.
Absolutely. I will take that advice, and I will say it comports with my personal experience, as my wife works in Washington, D.C.
Yeah, yeah,
We'll-
that's exactly
We'll
right.
assume when you said young people, you were definitely referring to us.
Of course, yes, of course.
Isn't that reassuring?
Yeah, I have an
Yeah.
antique. Tell me, well, another question, not a comment, or perhaps an ill-placed suggestion. How did you determine the step-ups?
Could you explain what you mean by step-ups?
You're going from 80 million to 110 million to 125 million. What was that just sort of, okay, let's see if this works? Or how did you, I mean, we're talking, that's serious money.
Yeah.
Yeah. You know, I think we started by sort of looking at the baseline, the base case of 80 million a year, saw that there was room there under these metrics that we had developed. We knew that there was a desire to increase the capital investment, as we've sort of talked about a little bit. And this $200 million figure, getting there gradually over time was something that we had talked to the city about, with $200 million sort of representing an amount that would help address not just the capital backlog, but also make new capital investments. So within that, you know, we looked at a lot of different things,
a flat
right?
increased issuance at a higher level to see how that would do over time, and
I'm sure you did, yeah.
yeah, so,
would hope
I
you
mean,
did.
in some ways, it was a collaborative effort, knowing that there was capacity to take on new debt,
Okay.
knowing where and I think there is a calculation in the financial statements of accumulated depreciation.
There is, yeah.
Which I think is very close to, we have someone in our office who was looking and crunching some of the numbers, is 200 million actually, you know, corresponds with the use of plant, you know, I don't know that quant analysis that he did, but it sort of tied into what you could look at the financial statements and suggest
okay.
based on some of the discussions we had. So it was, you know, I would say it was a collective effort in terms of how do we get
Yep.
from point A to point B.
Okay.
Knowing that a flat level of higher issuance could put more pressure on the city's
Yeah,
finances. We also think of it as like you're sort of easing your way in. If you get to that next level of issuance and you start to see ratios get pressured, you can stop there or at least pause there for a longer period of time before going to the next level versus getting to a point where the city's working on funding that a higher level consistently. So.
Okay, one last, I don't know, it is a question. The penultimate sentence on page, it's labeled page 4.
I think we're on the
the
planning
ci-
commission's report.
Okay. Oh, right, sorry, got carried away here. But it touches on something that the Controller Henry brought up earlier, is should a formal policy be adopted for annual review of these metrics? In other words, you know, I heard what you said, that it would be handled internally, but should it be the responsibility of this board or some other entity to have a formal review and reaffirm?
I'll just mention a conversation I had with Janelle and think that this is an appropriate time for her to mention what they do now in issuing debt. And then as as it relates to formalizing it, I really do believe that the answer to your question is yes. And we also talked about a timing.
Yes, so before we issue that, we do have ratios that we do run. We look at it on an annual basis. So, but we don't formally bring it to the board, but it is done on an annual basis. And so we're looking at now, just looking, when we end each fiscal year, that we will actually run those numbers and have like a formal report of those ratios to show that we are meeting the criteria that's been established.
Am I sort of mentally picturing the year-long budget process correctly when I say if you did this internal review basically over the summer each year in July and August, you could then bring something to the Board of Finance in the fall, sometime in September through November. That way, the board could review it also, and that way you'd have a reassurance of what your expected borrowing level was going into December, January, where you're really starting to make the big push on the next year's fiscal budget. Does that work well for finance?
I believe that it does. And Janelle, that works with Treasury's schedule as well, right?
That's correct.
My recommendation was similar,
Okay.
except I pegged it with the timing of coming to the Board of Finance for the capital budget approval. So a couple months ago, we approved the level of the capital budget. To me, that would be
Well, that was
the timing.
That was like September, October? October.
No, October is the school system, for the city is March that we bring the CIP.
And you brought,
Yes. The school, we bring the school in October,
okay.
Okay.
the school CIP, the
So is
city
that what
CIP
you're-
come in March.
Is that what you're
And
thinking of?
that's what I was referring.
Okay, well, that still works. I mean, we're still talking about the same
Yeah.
general chunk of, we're talking about fall.
Correct.
Yeah, okay.
Yeah, okay.
Yeah. Okay.
Okay, thank you. And I would just, because of the question, I believe before this meeting ends, that comes in a form of a recommendation that we would then carry forward.
I'm happy to make that motion. I just have one last question, I think, for you guys, as a follow-up to Fred's when he was talking about asking if you back tested. I was just curious, how many years back did you go when you back tested?
Go ahead.
Well, I was interpreting your question on back testing, meaning did we like quality control the model? And we go through a process where multiple people are going through the model. We do have several years of historicals in our model too.
We had the 22 historicals, and we looked at the 2017 through 22, sort of the old metrics.
Yeah.
Okay, so.
Oh, yeah, that's like 5 years.
Yes.
Yeah.
Okay.
I assumed you had done 5 years because you've done at least 6 years going forward.
Right.
Okay. Yes.
Mr. Chair, we have someone here from planning. If we wanted to maybe very quickly check with them on the schedule question.
I
She agreed.
Yes, you have the schedule correct. I did want to mention, if you're going to put in place a new review process, it might be helpful to have an understanding at the beginning of our budget cycle what the GO bond amount will be, rather than having that at the end when we bring it for approval at the Board of Finance. So we start working with agencies the prior fall. We start that process in September. So if we had that guidance in September, and then we could work with the agencies and then bring for your approval in March, the capital program.
Works? Yeah,
I think that works.
Yeah.
just as long as it's reviewed annually.
And the other thing is just for a caveat that the number that we have in the CIP may not necessarily marry up to what we issue, because we normally issue on a reimbursement basis. So some years it may be a little bit lower than what's actually in the CIP for the fiscal year borrowing.
Correct. And just one last clarification. This was really just reporting out that the debt study, debt affordability study was done. It isn't for us to officially
Yeah.
accept.
Yeah.
Yes, you have to accept.
Okay, then, okay.
So what I was gonna, I think I can do this in this order. That first I would propose amending the debt policy in the memo to formalize the review process that would have Treasury Management reviewing the data during July and August of each year, bringing it to the Board of Finance in September of each year to be approved. And that's my first motion as an amendment.
And I think we would take them separately.
Yeah.
And I would take that as a motion. Is there a second?
Second.
It's been moved and seconded. All in favor?
Aye.
Aye. And then.
That motion passed.
And then I would move that we move the debt policy in the memo as amended.
So moved.
And it's been moved and seconded. Again, all in favor?
Aye.
Aye.
That motion passed. Thank you, Janelle.
Okay, we have one more item.
Sure.
Okay, so now we're bringing back the Planning Commission's request for the loan authorization for 2024, asking for $250 million in general obligation bonds, $125 million for FY26, and $125 for FY27. This request, it needs to be approved by the Board of Finance, and then it goes to City Council for approval. If all approvals are received, then it will go on to the November 2024 general election ballot for voters' approval, and then it will be incorporated in the city's capital improvement. So based on the approval we just received from the debt study, the recommendation of up to $125 million in loan authorizations for each one of those years, we're requesting that the board approve the submission by Planning Commission.
Is there any questions of Janelle? And, yes.
Move approval.
Okay.
Second.
It's been moved and seconded. All in favor?
Aye.
Any, yes, no opposed. Thank you very much. That is passed. Is there any other business to be brought before us today?
No other business.
With that, I'd ask
Congratulations.
for a motion for adjournment.
So moved.
Second.
And that
Second.
Okay.
is approved as well. Thank
All
you.
right.
Thank you.
Merry
And-
Christmas to everyone.
The
Happy
next meeting is
holidays.
holidays.
next year. We see y'all next year. All right.
So I want to thank you for reminding me that this doesn't happen as often now that the pandemic. You're both much taller in real life than I thought you were. Yeah, on the street. I like the